physical demand for silver is overwhelming.
You wouldn't be surprised if we saw $100 silver by the end of the year or in January.
$100, I don't think it's out of the question. If you look at the gold-silver ratio, it's breaking down, which is a good thing.
Over the last couple months, the shortage of silver in London, we saw backwardation.
Dubai, they showed this silver bar. It was 1,971 kilos, so almost 2 tons. India is going to allow individuals and companies to use silver as collateral for loans. Tucker Carlson has started his own precious metals dealer. Might help wake people up a little bit.
We just had the CME group have a huge outage. It was multiple hours. It was out, the paper market and kind of the fragility there.
It's almost like they shut it down for hours. It's probably the biggest exchange in the world, derivatives exchange. For them not to have backup, continue trading is kind of far-fetched. For people who want to get involved in silver, I would say physical demand for silver is overwhelming the paper market. And 3.5 years ago, a little more, we had the silver squeeze movement. And that didn't really go anywhere. We got to 30, and then there was a lid there, mainly because the big sovereign buyers of physical silver that we're seeing now, and also big investors, they weren't interested in silver. They might have been buying ETFs, but they weren't interested in physical. But now everything's changed. And I think that's why silver is picking up. And also silver has still to catch up with gold, because don't forget, gold in 1980 got to just below 900, and now we are here at I think 4,200 as we speak. And silver got to like around 50 in 1980, and it's just moving above 50 now. So I think, since mid-October, there's been a correction, and a lot of people weren't too sure if silver was going to make it back up. But I think this is very significant that we made it back up, and we've made a new high. Yeah, gold is lagging, but I'm not concerned about that. I think if you look at the gold-silver ratio, it's breaking down, which is a good thing. Back in the 70s and also in 2011.
When physical demand overwhelms paper pricing, the real signal isn't the spike. It's who's suddenly showing up to buy. Silver crossing above its 1980 high while gold sits near $4,200 suggests a structural break in how these markets used to move together. As Mario Innecco hints, the gold-silver ratio breaking down echoes past inflection points like 1979 and 2011, when silver outran expectations. ETF buyers alone never moved the needle, but sovereign accumulation absolutely does. And the fact that silver regained its highs after an October correction shows underlying strength, not speculation. And next, the global footprint of this buying becomes even harder to ignore.
Towards the end of the bull market, silver really caught up and went higher. And I'm not saying the bull market is near an end. Precious metals, I think, is far from over. But usually it's good to see silver leading the way.
Certainly, and there have been some interesting developments with respect to, over the last couple months, the shortage of silver in London. We saw backwardation, which seems to maybe be reversing at the moment. But now I'm hearing of a huge buying from China as well. Your perspective on what is happening globally in the silver market?
Yeah, for me, the most important aspect is that actually central banks like in the Middle East, like the Gulf Cooperation central banks, even Turkey, Russia, China, they're all starting to buy physical silver. And I've even heard that Dubai now, they want to they're creating a tokenized silver instrument. Basically, they want to make silver kind of money again, which is quite amazing. I don't know if you saw the other day, Dubai, they showed this silver bar. it was 1,971 kilos, so almost 2 tons. And yeah, they're really into silver. We saw that India is going to allow individuals and companies to use silver as collateral for money, for loans, excuse me.
When central banks, not retailers, not hedge funds, start buying physical silver, it signals a shift deeper than a normal commodity cycle. Backwardation in London hinted at tight supply, but multiple sovereign buyers, including Turkey, China, and Gulf states, confirm this isn't a temporary squeeze. A 1,971 kilograms bar displayed in Dubai isn't just showmanship. It reflects growing monetary intent similar to gold's role pre-2000s. India allowing silver as loan collateral further shows institutional acceptance, not speculation. For long-term investors, these policy shifts matter more than daily volatility. Next, Mario Innecco shows why the Western investor may be the last to notice what's happening.
So yeah, up until 6 months ago, the reason people gave for silver underperforming gold was that, while central banks only buy gold, they never buy silver. But that's completely changing, and I think that's huge. And I think the silver price, right now we are like in what one would call terra incognita. Like we're in territory we don't know. It's never been there before. But yeah, I think there's such huge potential for silver now that central banks are getting involved. And unfortunately, in the West, very few people are aware of this stuff. I mean, you and I are aware because we listen to you listen to me, I listen to other people in the gold and silver space. But the mainstream is like completely like not really aware of it yet. Maybe the fact that like Tucker Carlson has started his own precious metals dealer might help wake people up a little bit. He's got a big following. So yeah, that's the major thing. These countries outside the West, yeah, they're going back to silver. Even Korea, South Korea, the central bank there has started buying gold again, but also silver. So, and we also seen, Elijah, that the United States and China, they've put silver on their critical minerals list. So everyone wants to get silver before those two giants get a lot more.
And you were just talking to yesterday.
The narrative that central banks only buy gold collapsed in just 6 months, yet Western financial media still pretends nothing has changed. With South Korea, China, Gulf states, and even the US labeling silver a critical mineral, this market has entered a phase with no historical roadmap. When institutions expand into a metal previously ignored, price discovery becomes volatile but structurally bullish. As Mario Innecco notes, mainstream investors are the last to learn, while sovereign buyers quietly accumulate. That information gap is exactly where long-term advantage is built. And what follows shows why price acceleration may arrive faster than most expect.
About how you wouldn't be surprised if we saw $100 silver by the end of the year or in January. Your perspective on that, it seems like we have seen kind of a different market ever since silver passed the $35 level or thereabouts, because it's just kind of been going up in a straight line. We had a little hiccup over the last month and a half, but we have been seeing $1 or $2 days for silver. You're expecting potentially $5, $10, $15 days. Can you expand on that?
Yeah, I remember back in from 05 to 08, even though I was a futures and options broker for government bonds, we had a client that traded a lot of silver. And so I was involved in that, and I could remember $5 days when silver was between $15 and $20. So I don't see why we shouldn't see $5 days again, especially now that we are above 50. And as we speak here, we're just trading at 56, the spot price. That's a new all-time high. And we're actually up, Elijah, $2.60. Which is half of, $5. But yeah, $100, I don't think is out of the question. Back in 1979, I think silver was at $16 in November, and by even end of November, and by January 1980, it got up to 50.
When a market shifts from $1 to $2 daily moves to talk of $10 to $15 days, it's a sign liquidity and price discovery are no longer controlled by the usual players. Crossing $35 changed silver's behavior, much like past breakouts in 1979 and 2005, when volatility surged as new buyers overwhelmed legacy pricing structures. With spot above $56, an all-time high, the comparison to the 1979 run from $16 to $50 in roughly 60 days becomes more than nostalgia. It becomes a warning of how quickly silver can reprice under stress. Investors should respect both the upside and the velocity that comes with it. Next, Mario Innecco turns to whether this acceleration ends in a blow-off top or a structural reset.
So it like tripled. So we could very easily double. And if we double, we're at 100. That's why I said that in my video from yesterday.
Right. And I mean, silver is on track to make its highest monthly close ever. And I think first close ever above $50 as well on a monthly basis. What do you think the significance of that will be? I mean, by the time this is posted, our viewers will know, and we can put a little asterisk there to see if we made it. But I'm sure we will close above 50 at least.
Yeah, I think so. We got like a few hours here on Friday. I'm not sure they'll be able to get it back below 50 from 56. And the other thing as well, if you do a long-term chart of silver and you draw that teacup that's been forming since 1980, the top of the teacup is around 51.50. So not only we're getting like record monthly closes, we're getting a technical close above that lid, which is huge. And the thing is, back in October, we went above that level.
When a metal pushes toward its first monthly close above $50 since 1980, it signals a structural revaluation rather than a temporary spike. Silver breaking through the long-term teacup lid near $51 suggests a macro shift similar to commodities that re-rated during 2004 to 2008, when liquidity and global demand surged. As Mario Innecco notes, holding above $56 into a Friday close limits the ability of paper markets to force a reversal. For investors, a breakout at a 44-year resistance level changes long-term pricing assumptions. What Mario Innecco says next raises deeper questions about whether this momentum can be reversed at all.
That lid, we went to 54.50 or 60 or thereabouts, and then we corrected back down to below 46 very quickly. And technically, that's very bullish. You retest the breakout by going back below the breakout, and now we've gone back above. So I'm not saying silver, I don't like to say, silver will never go below 50 again, because I think it still could. You never know in the precious metals market, but the likelihood is a lot smaller today.
And what is your take on, we have always advocated on this channel, and we can't give financial advice, but I think my position has always been it's best to hold the physical metal either in your own possession or stored. We just had the CME group have a huge outage. Your perspective on that? It was multiple hours it was out. So your take on the paper market and kind of the fragility there?
Yeah, I don't recommend at all for the average investor, especially if they don't have experience in markets, professional experience like I have and other people. Futures trading is just for professionals, I think, and speculators. And they shut the market down. Some people are saying, they shut everything down.
A breakout that retests its support and launches higher is the kind of behavior technicians wait years for. Yet the real story here is the fragility exposed by a multi-hour CME outage. The pattern is classic. Silver touched 54.60, dropped to 46, and reclaimed the range, exactly the retest traders like Stan Weinstein highlight in Stage 2 breakouts. But outages during high volatility phases raise serious questions about paper market reliability, especially for non-professionals. Physical holders avoid this operational risk entirely. Next, Mario Innecco digs into why even technical glitches should not be taken at face value.
It wasn't just silver, but I don't know. It smells. It's a little bit suspicious. It's almost like, they shut it down for hours. A CME exchange is probably the biggest exchange in the world, derivatives exchange. For them not to have backups and continue trading is kind of far-fetched, especially during this Thanksgiving weekend where the markets are a lot quieter. There isn't that much activity. We've seen a lot busier days where everything runs smoothly, especially back in October when silver was down massively. They didn't close anything down. Yeah, they're going to say, oh, it was a technical glitch. But yeah, physical, I always say you start with physical. That's how I started back in '03, buying physical silver. I had started buying gold a year earlier. Avoid futures, avoid ETFs. The reason I say that is because ETFs are just a promise. They say they've got silver backing it, but I don't trust the banks. You've seen what happened today on the CME/COMEX. They just closed it. They could do the same thing with the ETFs. They could decide not to deliver to you, or even big institutions.
When the world's largest derivatives exchange goes dark for hours during a thin volume holiday session, investors deserve more than a boilerplate technical glitch. Silver traded heavily during far more chaotic periods, October's plunge included, with no shutdowns, which exposes an uncomfortable inconsistency. As Mario Innecco notes, futures and ETFs rely on counterparties and custodians, and 2008 proved how quickly trust can evaporate when delivery risk reappears. Physical metal removes that dependency completely. And next, Mario Innecco turns to the only segment where leverage still makes sense for some investors.
And then there's the mining stocks. If you want to get involved and get more leverage to the silver price, I don't see why not. It just depends on the individual. And because sometimes I guess if you don't have enough room, it's quite bulky to get physical silver, so it could be easier to own some silver producers. That's the other alternative, I would say. And again, not financial advice, like you said, just our opinion.
Certainly, it's crazy just to see silver move it. Since we started this conversation about 50 cents up here, I guess.
So up $3 now.
Yeah, it's insane. So I guess for those who are new to the silver space, it seems like, I guess buying now could seem like kind of chasing the price and stuff like that. What I always think of is that if you don't have anything, first and foremost, precious metals are kind of insurance purposes. So it doesn't necessarily matter a whole lot what the price is. Your take on people who are looking at the markets right now, seeing them going parabolic in some sense, what should be their perspective in your view?
I think people should remain calm. I try to stay even keel, even on the way up.
Parabolic moves pull people in, but silver miners and producers aren't a shortcut unless investors understand how leverage cuts both ways. Mining stocks historically move 2 to 3 times the metal's price, but they also lag sharply when costs rise or production falters. Just look at Q2 2022 margins when energy prices spiked. Innecco's reminder that precious metals function as insurance first helps recenter the conversation for newcomers. Positioning slowly avoids the psychological trap of chasing vertical charts. And next, Mario Innecco explains how disciplined buying beats emotional timing every time.
Back in the beginning of October, the market went crazy on the way up, especially gold. I tried to stay calm and not too excited. And the same thing when it corrected. Same thing now. But for people who want to get involved in silver, I would say don't go in all at once. I don't. If you have a certain amount of dollars, don't go and buy all of it in silver, maybe dollar cost average, and don't worry about the price, because if you do it regularly, you're going to get a period when the price is corrected down. So yeah, I think that's the best thing to do. But it's getting, I think we could see next week silver be very explosive to the upside. We could see a lot of volatility as well. And I expect the premiums to go higher for silver, because the dealers, when it's very volatile, they need to have a wider bid and offer spread to protect their profitability. So
Everyone wants the perfect entry. Yet Mario Innecco's point is that dollar cost averaging worked even during October's whipsaw, when gold swung sharply and silver followed. Volatility tends to widen dealer spreads, often 10 to 20% during stress, which quietly penalizes emotional buyers far more than those who pace their purchases. Historically, explosive weeks in silver cluster around liquidity events or macro shifts, such as Fed meetings or CPI prints, making steady accumulation the more rational path.